Hi, thank you for listening today and watching today. My name is Mike Province. I am currently the managing director of a business I have doing contract executive and consulting work for small technology-based and technology ventures. I've been running and helping run and advising tech companies now for about 25 years, a wide range of technologies, but all using and based on information technology, data analytics, and the like. Have done work with getting MapQuest 1.0 off the ground, building internet properties for AIG, GeoCities, which was part of Yahoo at the time. I have also worked with special forces and the Navy to do technology horizon planning and kind of looking at the future of technology. So I come at the idea of building technology businesses with an eye toward how to grow them more than just how to get them off the ground. And in fact, today I wanted to take the opportunity to talk to you about the challenges that come to a small company after the startup phase and as it heads into growth phase, really looking at the problems of how do you finance the scaling of your business, and in particular what the differences are between the venture capital, the venture finance market for the startup phase and the growth phase, and hope to leave you with thoughts and some guidelines in how to think about your business as you're, today probably getting it off the ground or in the process of starting it. There are things you can do and be thinking about that ensure that when you make that transition from startup to growth, you are set up for success. It's interesting because when you look at entrepreneurial companies and the ecosystem and the communities for it today, the world of entrepreneurship is about startup, and that's really why you're here. That's why 1004 exists. That's why we all do what we do, is to get new companies off the ground. But in fact, the challenges of starting up create the challenges of growth later, and similarly, the things you do to ensure your startup process goes well, if you're thoughtful about how to do that, can then inform the way you grow the business in the future. And really, we're all in this to grow bigger companies, not to stay at a startup size. But it's kind of ironic or funny in that when you look at the media today and the stories about entrepreneurs and the focus on entrepreneurship, tends to all be about startup and not so much about how you scale a business beyond that initial 0 to 10 size, or that first $1 million of revenue, or that first few customers, which are all important but are just the beginning. The growth stage is a stage that focuses on profitability more than revenue. And a way to think about this, and there's a slide that will follow here that will show you, the layers that companies go through in raising venture or any kind of financing, go from this early stage position through a growth stage and then into later stage financing, and finally liquidity events that we all aspire to with the businesses we run. But if we focus just for a minute on that transition from early stage, which is the kind of end of the startup period, into the growth stage, one of the biggest changes that occurs is what investors look for and what they reward. Right? In the early stage, investors are seeking companies that have validated their product and their market and the fit there. They're seeking companies that have revenue stream and dependable revenue stream and measurable revenue. They're seeking companies that have somewhat of an established reputation, but far more have a little bit of traction in the marketplace, some revenue momentum, if you will, and that they're creating value that's new to the market. That's what attracts investors. And we can talk about the kinds of investors that attracts versus the types of investors that look at growth stage businesses, which, while there is overlap, do vary. And in that growth stage, what you're looking at are investors who seek out firms that have profitability, their past operating cash flow, or if not past it, at least they're on a very visible path towards profitability. And they're in the process of building scale and capacity into their product development and their operations, and particularly delivery and support operations. It's a noticeable shift in the investors that occur between these two stages that I think is highlighted by the data on this slide. When you look at, in this case, the data from the fourth quarter of 2015, venture capitalists put in about $4.9 billion into early stage companies. And speaking specifically about the venture capital form of financing versus, say, a private equity, family foundation, or other source of financing. By contrast, at the growth stage, the venture capital community in that same fourth quarter put in $3 billion into far fewer deals. A couple things that we can kind of observe from that. One is that as we make that leap from early to growth stages, the kinds of venture investors we're talking to are going to shift. Venture capitalists focus on, to a certain extent, more risky ventures, although they're always looking to de-risk those opportunities. But they're more willing to put their money to work because they have a longer-term horizon for returns, and because their job is to take on more effectively higher beta kinds of companies in their investments. Growth stage requires bigger investments, and therefore they're making those at a much smaller scale in terms of numbers of companies because they simply don't have the fund to do it. Typically, venture capitalists are raising funds in the hundreds of millions of dollars, where private equity firms' funds are in the billions of dollars. And so growth stage companies tend to be much more attractive to those private equity firms. And within the private equity community, there's a tiering of size of private equity firm that often drives certain PE firms to pursue smaller deals with entrepreneurial ventures. Why is that important? Well, these are two very different types of funding vehicles. And the investors that run those funds often look very differently at the investments they're making, both in how they're going to structure the deal and how they're looking to have control in the company as it goes forward. Before we get kind of into what I'd like to say are guidelines or rules that I've developed for myself over the years, and that I think are good rules to have in the back of your head as you're heading into growth stage, I wanted to talk a bit about the differences between early stage and growth stage, or in this case, what I'm speaking of are differences between your mindset as you're going through startup and the mindset that one has as they're looking to scale the business. And they primarily hit four different areas. Right, you're looking at strategy and goals differently as you move from startup to scale. The systems and the business infrastructure that you put in place is going to be very different. And this is probably one of the starkest places you'll see differences, because in that period of startup, we actually benefit from not having process, from not having structure. From limiting the number of rules that drive the way we run our business. Now, that's not to say we're rules free, but it's much better to be able to adapt and change and pivot and tack as the need arises. And two things happen as businesses grow, right? You add resources, meaning you add people. People require care and nurturing. People require processes and systems that help them do their work. So as you go through this phase of 0 to 10, or 0 to 30 as a startup company, if you will, and you pass 30 and you start to feel the pain and you start to see the cracks in the foundation that occur when your company's infrastructure, the business model, the business tools you've built can't support the size of the business, you begin to think about the need to scale. And as you plan for 30 to 75 or beyond 75 people, this is where we get into the growth stage. And in growth stage, we have to start to look at systems and processes and capabilities in the business that aren't all revenue producing. You know, one of the probably fundamentals of startup stage is every resource you bring in, every person you put on the team, every executive or part of the management team you put together, in one way or another is generating revenue. That starts to change as you focus on scale. You begin to need to build delivery capabilities and customer support abilities. You may be outsourcing manufacturing or outsourcing certain services. For example, the company I worked with recently, we, in order to deliver a complete package of services, software and labor services to our customer base, partnered with offshore companies that were providing labor behind the scenes for our operations. The level of intensity, the level of investment, and the level of complexity that grew from a few simple partnerships put a tremendous weight on the business to try to manage that growth and manage that operational capacity. These are the kinds of things that growth financing focuses on in the business. You're not trying to, by the time you get to growth stage, you have already figured out where you're going to create value. Now, you may extend your product, take it into new markets, add functionality, but by and large, whatever your business is about, whoever you are, you've established that in startup. Now the job is to take that brand, take that product, take that service, and blow it out to the market as quickly and as aggressively as you can. Within reason, because you want to manage that growth, which we'll talk about in a minute. So it's important as you think about that change of mindset. You're no longer creating, and it doesn't mean you won't ever be creating again, but you have to start to balance the act of innovating, the act of creating, with the act of producing, delivering, supporting. And these are very different skill sets for the typical entrepreneur or founder, if you will. And this is why at this point in time, when you're clearing 15, 20, 30 people, when you're building out your management team, you need to be very thoughtful about who you're putting on the team, right? This becomes a very critical piece, in fact, of how investors value your business. Who have you brought into the team? Who have you aligned yourself with? Not only do they have the right skill sets, but have they come from the right companies? Have they had the right experiences in the past? Are they set up to help you succeed, help your company succeed as it grows in this next stage of evolution? And then finally, this is a point in the organization. A way I like to look at this is in entrepreneurial ventures, from about 0 to 10, you know, they're following you. They're following the entrepreneur. They believe in the entrepreneurial team and the vision it has. They aren't there for a job. They're there to be part of changing the world. As you clear 10 people and you start into that next round of 10, 20, 30 that you're bringing on, they're still very passionate about the vision. They still love what the company's about. That may continue on into the hundreds of employees, but one of the things that does shift as you move beyond that group is people start to need job descriptions. They still start to need to understand how they participate in making this business successful. And this is where kind of organizational design, thoughtfulness about leadership, management structure, complexities around the nature of how the organization is going to make decisions become more and more vital as part of the growth process for the business. Typically, you're not going to see investors investing directly in this, but they're going to demand that it's in place, or that you're thinking about how to put it in place, because they know that this is one of the linchpins of the difference between a successful venture moving through growth and one that doesn't succeed. So we've talked about the kinds of investors that we see at these different stages and some of the things that are impacted as you move from one stage to the next. I guess I wanted to finally take you through a set of rules that I believe will help you think about the best way to organize your business as you're moving out of that stage of violently, aggressively creating new product, taking it to the market, wowing the world, and you're thinking about, okay, now I've got my first revenue. How do I generate revenue reliably? How do I grow that revenue reliably? And how do I get this business profitable? It's great if you're already at profitability, but these rules work regardless, because this is the tipping point or the inflection point at which you're going to start to ramp your business's size up dramatically from where you've brought it to today. And in that regard, the first rule of thumb I would talk about is violently pursuing incremental growth. And what do I mean by that? There's a tendency to want to grow as fast as possible, to seek out as many partnerships and channels and distributors as possible, and to just create revenue flow. And that's a great aspirational challenge to have. It also creates a myriad of really, really difficult, bad operational problems when you bring too much revenue in too quickly. And fortunately, that's not a problem that most companies have. Usually the struggle is to get enough revenue. But a mindset where your focus is on revenue growth, operational capacity and scale, revenue growth, operational capacity and scale, so that you're pushing your organization, you're straining the boundaries of it, but you're not pushing the revenue faster than you can grow the business. And many people often believe, well, I can just add people, hire people, bring people on as I need to. And this is a rule I've learned the hard way. Having a mindset where you're just going to hire to address capacity leads to catastrophic problems later. Part of growing incrementally is hiring very thoughtfully and very carefully and bringing the right people on to support the right roles at the right time. At the size you are, when you're 20 people or 30 people or 50 people, that's still very small. One bad hire can be very disruptive, if not destructive, to the organization. And you are going to make bad hires, but being thoughtful about it and carefully looking at it up front, being slow to hire and fast to fire, are important steps or choices you can make at this stage of growth in the business that support the notion of being able to grow in a managed way. This doesn't slow you down. What this actually presents to investors is a methodical, or picture of a methodical company and methodical leadership that understand all facets of what it takes to grow, and not just revenue, because you can grow your revenue rapidly and in the process kill profitability and cash flow, or you can grow thoughtfully and raise revenue, profits, and cash flow all at the same time. And the second one I will say is, and this is a kind of a, not so much a lesson I've learned because I've always believed this, but something I've observed as I've worked with hundreds of small companies, is most all of them believe they're unique, and therefore believe the way they grow, the things they do, the choices they make, these are all unique. And I can tell you, after seeing 3 waves of investment in internet technology, 2 waves of investment in healthcare technology, there are patterns to every business model out there. I have boxes full of notebooks from 20, 25 years ago pitching the same business models that we think are unique, novel, and new to the world today. The difference is the technology today supports those models much more than it supported it 25 years ago. But the thoughts, the models, the strategies, all of these things have been kind of recursively developed repeatedly over the last 3 decades of what we can call kind of contemporary information technology, right? Post mini computers and the beginning of micro or PCs and microcomputers. What's important here is to know that patterns are everywhere. When you think you've got something unique, you aren't looking far enough or wide enough or deep enough to see that the pattern is consistent with other companies or other industries' patterns. Things you can learn from, things that you can essentially expedite your scale and growth. These patterns will always come back. So you can always dependably know that whatever you're seeing in the environment, whatever you're seeing in your market, you're going to see that again. Right? We live in a cyclical economic world. We live in kind of a cyclical organizational world. Notions of culture, notions of structure, everything we bump into will be improved upon, but will cycle back in one form or another. So as you begin to build and grow and prepare to scale the business, you need to look at the data you have about your business and see the patterns in the data, look across a lot of data together to try to understand that. What I take from this notion and this rule and what I use when I work with companies is that you need to become a data zealot. You need to constantly measure many, many facets of your business, not just revenue, profits, not just the financial measures, but operational measures, productivity measures, quality measures. All of these things taken together create the patterns that we're looking for to understand where the business can go, where it should go, and what things are standing in the way. Another thing to think about in this regard is don't measure the nodes, measure the system. And what I mean by that is too often we get sucked into the notion that our business is made up of modules or departments or functions, and we measure within those things. So we measure how well our product team is building product, or we measure how well our sales team is delivering new contracts. But our business is actually a system or set of systems of activity that cross over all these different functions and cross through these different nodes, which are essentially people. And we rarely or much less regularly measure the systems that are going on in the business. We don't spend the time, invest the time to understand what systems we have and are they working for us or are they working against us. So focus on measuring the systems, not the nodes, not the functions or the departments. The third guideline, rule, practice, if you will, is to model the hell out of your business. You know, by genetics, probably by 30, 40 years of professional life, I'm an analytical type of person, and so modeling comes naturally to me. But modeling needs to be a part of every entrepreneur's repertoire. Not just focusing on the sale, not just focusing on the technology you're building, but actually sitting down, doing this not alone but with a team, and figuring out what can this business look like, what's the trajectory, and then being able to build a financial picture of that, an economic picture of that. If you think about it, the things we measure in the income statement, balance sheet, cash flow, all we're doing there is assigning currency value to all the different operating pieces of our business. Right? And so if we can step back from the numbers, we see the picture of how the business runs and how it could be running. When we dive back into the numbers by modeling that, we paint a picture of what the future of the business can look like. Does that mean it will? Hell no. It never does. I mean, I'm a big believer in what General Patton said about an 80% plan executed violently is way better than a 100% plan that never gets executed. But if we aren't modeling it, if we're not even trying to push our thinking beyond where we are today, we won't achieve the kind of growth, the kind of scale that's possible in the business until it's too late, because we'll always be acting and operating with a rearview mirror rather than looking through the windshield. This also is important because in this period of going to raise money for scaling your business, investors are looking for predictability. They're going to take all your data, they're going to model it themselves. The cleaner you can make that for them, the better you can present a picture that you've thought about the future and you've modeled it and you know what it looks like, and you can provide predictability, if you will, helps them gain confidence that the management team understands the challenges ahead and has solutions and strategies for approaching that. At the same time, the environment is anything but predictable. We know it goes through cycles. We know we probably have a bubble on the horizon. But the fact is, the environment will always shake up whatever model we have, like it's an Etch-a-Sketch, and make us start over. But we aren't starting from zero when we have a model to be based upon. And when I say model this, model it over and over and over, and keep tuning and keep fine adjusting it. I think the last company I worked with during the last fundraising round, I probably put the model to bed at version 84 because any kind of fundraising effort happens over time, and because it happens over time, things change in the business and in the market and the economy around the market. And finally, let me wrap up with this is more of a nothing you can do about it other than make good decisions, but not all money is green. Right? We know that investment can either be expensive or cheap. Equity can be expensive or cheap. Cash can be expensive or cheap. Debt can be expensive or cheap. It really depends on where your company is in its growth pattern, what market you're in, the industry you're in, and the economy and the condition of the economy around you. So don't make assumptions about, well, my equity is very valuable, I'm not going to release it, or I have this cash, I'm not going to use it. You need to really, and this ties back to some of the points before, you really need to understand where the business is today, where you're trying to head, and what the expectations of the investors that you're going out to reach are as you're doing that. And those expectations vary, right? We talked about different types of investors, that you have venture capital investors, you have private equity firms, you have family foundations. Each of these types of investors has a very different profile regarding what it considers good investments, the structure of how they're going to pursue those investments, and the expectations they have for the terms that are delivered when the deal is signed. And there's, there are a lot of really good resources out there. There's some excellent books written from the venture capitalist point of view, one by Brad Feld and another recently published, that share some insider tips about what you should think about as you're entering into these deals. It's also important when you're into the phase of raising money for scale. I think it's very valuable to bring on an investment banker that represents you. You may not have done that during startup. It may seem excessive to pay a few points here to gain that expertise during the startup phase, but when you get into scale, you're dealing with a bigger investment, you're dealing with a more complex investment, and because you've been operating for a while, the starting point for negotiating that next round is more difficult. And having somebody that can take you through that can effectively go out and find the different types of money for you and give you a sense of how they vary as you're looking at them, becomes a very valuable resource. And really, after 6 or 9 months of running around putting this raise together, the few points you're going to pay them or the investor's going to pay them becomes almost meaningless compared to the level of value you get from it. You need to remember that the valuation of your business increases with the company that you keep, but only to a point. And I mentioned earlier that the people you bring on your team affect the valuation. So do the partnerships you have, strategic alliances. In some research I did recently with a couple of colleagues, we identified the fact that the number of strategic alliances you have, there is a optimal level at which valuation reaches its highest point. So you can have too few and your valuation isn't optimal. But if you have too many, the signal that the investors look for becomes muddled, and kind of that value is erased and the valuation drops. So there's a lot of factors that affect valuation, but a big one is how you position yourself from a reputational point of view, from an experience point of view, as you're moving into this growth stage of capital raise. Finally, the raise is going to take you 3 times as long as you imagine it will, and it's going to cost you 3 times more in control than you think it will. These are, rules of thumb, not actual data, but it's roughly average that you should expect to spend 3 times more of your time and give up 3 times more control than you think you're going to give up as you go into this round. And for good reason. The money that's coming in is funding a round of or stage of growth that is going to take you from 1 or 2 orders of magnitude lower to a very accelerated rate of growth and profitability. The other thing that you probably know from your first attempt to raise money, but certainly hits home here, is it's going to consume you. So whatever you have to have in place management-wise, executive team-wise, business development-wise, get that in place and then devote yourself to the raise, because you are not going to have the luxury of spreading yourself across a lot of different responsibilities. And this is a scary time for your team. You may be doing exceptionally well in growing the business, but during that startup phase, you've stressed your team out from them taking on everything they could take on to help it grow and pushing them past points of pain. And now we're heading into a period of uncertainty as we think about how to grow this business and scale it. And often they aren't familiar with the process that you're about to go through in raising that money. So be sensitive to that. Make sure you are supporting the team. Make sure you've put in all the cultural, organizational support that needs to be in place, and keep them in the loop as you're going through this. Everything you're about to raise to help scale this business is going to impact them directly, because they're the ones on the front lines of delivery operations, customer support, sales, product development, manufacturing, service delivery, whatever it is that you're about to scale, they're the ones that are going to feel the brunt of that investment. If I can kind of wrap this all up, concluding with, you need to align your investment strategy to where you are in your growth. Many of you may still be in startup mode. You may just be dreaming of the idea of scale, or some of you may be thinking it's time to move into scaling this business up. The types of investments you raise to help you get started are not the same investments that are going to drive the growth through this next inflection point. Spend some time understanding that, bringing in the expertise to help you understand it, and build a foundation that you can grow from, both organizationally and financially. Also, raise more than you need and start earlier than you think is the right time to start this round for raising growth capital. Depending on when you are in the cycles, growth capital, like venture capital, tends to go through cycles of being very available or not so available. And in fact, one of the things we've seen over the last 3 years is increasingly both venture capitalists and private equity firms are holding back more and more dry powder, meaning more capital that they're not investing today, to be able to protect their existing investments in the future. And so what we're going to see, this is 2016 now, as we look ahead in the next couple of years, the markets for venture capital and PE may tighten up, and that may affect your ability and speed at which you can scale things. So raise more than you need and start earlier doing it. Be very thoughtful and careful about how you pick your partners, both the strategic partners that you're utilizing for the operations, but in this instance, your investment partners. In this growth stage, they're going to have more control, maybe not in the form of equity ownership, but certainly in the form of downstream control of exit of the business and liquidity events and rights that they have before anyone else. So you need to be very careful to pick people that want to work with you in driving the scale. And finally, focus on the fundamentals. Like that applies at any scale, but it's too easy often to get lost in the glitz of the raise or the glitz of being a venture-backed company, and realize that what you're really trying to do is build a company that provides meaningful value, grows time over period over period over period, and creates profitable cash generating business into the future. And that's what scale is about. Thank you for listening. Thanks for your time. Appreciate it.